The stock market has never been a game of who finds the best opportunities the fastest. It has always been a device, Warren Buffett's exact word, for transferring money from the impatient to the patient. Every notification, every trending ticker, every fear of missing the next rally is simply the mechanism of that transfer. And right now, most people are on the wrong side of it. Think about the last time a stock chart went vertical. The breathless headlines, the social feeds lighting up, the quiet, gnawing certainty that everyone else was getting rich and you were standing still. That feeling has a clinical name. It is called FOMO, the fear of missing out. And in the context of financial markets, it is not a minor inconvenience. It is a wealth destruction engine. Before we go further, if you are watching this, you have already made a choice most people never make: to study markets rather than react to them. That discipline is the entire game.
If this channel deepens your commitment to long-term financial clarity, consider subscribing. Your presence here strengthens a community of investors building real knowledge together. Tell us in the comments, what is the core investment principle you refuse to abandon, regardless of market noise? Your answer matters to every person watching.
FOMO in financial markets is defined precisely. It is an acute state of anxiety arising from the belief that others are extracting significant profit from opportunities you are currently missing. That definition is important. Notice what it does not say. It does not say others are profiting. It says you believe they are. The distinction is everything. This anxiety is not random. It is rooted in a deep evolutionary drive, the human need for social belonging. For most of human history, being excluded from the group was a genuine threat to survival. That wiring still runs in us. Financial markets simply found a way to weaponize it.
The result is a predictable behavioral pattern, the complete abandonment of fundamental analysis in favor of what researchers call the bandwagon effect. Instead of reading balance sheets or studying cash flows, the FOMO-driven investor asks one question only: what is everyone else buying right now? That single substitution is the source of enormous, measurable, and entirely avoidable financial loss. Now, consider the architecture of the platforms where most people trade today. They were not designed to help you think. They were designed to keep you moving. Leaderboards showing the day's top-performing assets, rankings of the most volatile tickers, push notifications timed to periods of peak emotional susceptibility. These are not neutral tools. They are environments engineered to manufacture urgency. The data on what this engineering produces is stark.
Researchers found that users of gamified trading platforms concentrate 35% of their net purchases in just 10 stocks. That is 11 percentage points higher than traditional retail investors not using these applications. 11 points of concentration driven not by research, not by valuation, but by what the interface chose to display. What if the very act of trying harder, checking more often, trading more frequently, reacting more quickly, is the precise behavior that guarantees you will fall further behind? In the early 1990s, two behavioral finance researchers named Barber and Terrance Odean set out to answer that question with evidence rather than theory. They analyzed the complete transaction histories of 66,465 households trading through a major discount brokerage between February 1991 and December 1996.
What they found should be taught in every school that claims to prepare young people for financial life. The average household in their study turned over 75 to 80% of its entire portfolio every single year. Not a small portion, not the speculative edge of the portfolio, the whole thing, rotated,
replaced, and churned at a rate that generated enormous transaction costs and tax liabilities before a single dollar of net gain could be realized. Before those costs, the average household was actually keeping pace with the market. Their gross annual return was approximately 17.7%, competitive with the benchmark's 17.1 to 17.9% return. The problem was not that they were picking bad stocks. The problem was the trading itself. After commissions, bid-ask spreads, and taxes on short-term gains, the average household's net return collapsed to 15.3%.
The market returned 17.9. That gap, nearly 2.5 percentage points per year, is not a rounding error. Compounded across a decade, it is the difference between a comfortable future and a mediocre one. But the most devastating data did not come from the average household. It came from the most active traders, the top 20% by transaction volume. These investors turned over their portfolios at a rate exceeding 115% annually, more than the entire portfolio replaced every single year. Their net annual return? 10.0 to 11.4%, against a market that returned 17.9% in the same period. The most active traders, the ones reacting fastest, working hardest, staying most alert, earned roughly 60% of what a patient investor holding an index fund would have earned by doing almost nothing. Barber and Odean's conclusion was categorical. Trading is hazardous to your wealth. What drives this behavior? The researchers identified a single dominant cause: overconfidence. Investors irrationally believe in their ability to predict short-term price movements. They overestimate the quality and uniqueness of the information they hold. And so they reach a false conclusion: that the expected profit from a quick trade will exceed the guaranteed mathematical cost of making it. It almost never does. Ask yourself this: if hyperactive retail investors lose so consistently, perhaps professional fund managers, armed with Bloomberg terminals, research teams, and algorithmic execution, can beat the market through active speculation? The data answers that question with uncomfortable precision. The S&P Indices versus Active Scorecard, known in the industry as SPIVA, tracks this performance systematically. In 2025, 79% of all large-cap U.S. equity funds underperformed the S&P 500. On global markets, 76% of professionally managed funds fell short of their benchmarks. This is not a bad year. This is a recurring structural reality. Extend the timeline, and the picture darkens further. Over a 15-year horizon, researchers found not a single category of active fund managers, not in equities, not in bonds, where the majority beat their index. And over the 20-year period ending in 2024, nearly 64% of domestic equity funds were liquidated or merged with other funds due to chronic underperformance and capital outflows. Let that figure settle. Nearly 2/3 of professionally managed funds, run by credentialed analysts, staffed with researchers, operating with institutional infrastructure, did not survive 20 years of trying to beat a passive index. They were quietly dissolved, their track records erased.
This is the central empirical truth of modern finance. The market does not reward activity. It does not reward speed or vigilance or the number of hours you spend watching tickers scroll. The research is unambiguous. The more you trade, the more you pay. The more you pay, the less you keep. The less you keep, the more you trail the very benchmark you set out to beat. And yet the platforms keep sending notifications. The social feeds keep surfacing the week's biggest winners.
The architecture of modern finance keeps converting investors into speculators, one anxious click at a time. The question now is not whether the trap exists. The question is whether you understand it well enough to step around it.
They have Bloomberg terminals, research teams, decades of experience. Surely they beat the market. This content is for educational purposes only. They do not. Every year, S&P Global publishes a report called SPIVA. It tracks how actively managed funds perform against their benchmark indexes. The results are not ambiguous. In 2025, 79% of large-cap U.S. equity funds underperformed the S&P 500. Not a minority, not half. Nearly 4 out of every 5 professional stock pickers, with all their resources, all their analysts, all their models, delivered less than a simple index. The numbers do not improve with geography. 76% of global equity funds underperformed their benchmarks. The pattern is consistent across borders, across markets, across asset classes. But perhaps one bad year is forgivable. Markets have cycles. Perhaps the professionals recover over time. Over 15 years, not a single category of active managers beat their index. Not one.
The longer the time horizon, the more devastating the verdict. And the funds that failed did not simply post weak returns. Many ceased to exist entirely. Over the 20-year period ending in 2024, approximately 64% of domestic equity funds were liquidated or merged away. Think about what that means. You cannot even measure the full scope of underperformance because nearly 2/3 of the evidence has already been quietly buried. If the professionals cannot do it, and the data proves it, then what exactly is the correct move? The answer is not to try harder. It is to stop swinging at bad pitches entirely. Warren Buffett understood this in 1974. He gave an interview to Forbes magazine. He said, "You never have to swing. You stand at the plate, the pitcher throws you General Motors at 47, U.S. Steel at 39, and nobody calls a strike on you. Nobody calls a strike on you. In baseball, hesitation is punished. In investing, it is rewarded." The market has no umpire. You can wait indefinitely for the perfect pitch, and every moment you wait costs you nothing. This is not passivity. This is precision. One investor waits because he is afraid, frozen, directionless, hoping the right moment will announce itself. The other investor waits because his standards are high, calm, deliberate, entirely in control of the decision. Ted Williams understood this distinction before Buffett ever applied it to finance. Williams finished the 1941 season with a .406 batting average, a number no player has matched since. His method was not raw talent alone. It was systematic patience. Williams divided the strike zone into 77 baseball-sized squares. He mapped his own performance across every single one. His insight was ruthless and simple. Only swing when the pitch lands in your happy zone. Let the rest pass. The crowd may boo the patience. The scoreboard only records the hit. Buffett applied this framework to capital allocation. His happy zone is a business he understands deeply, trading at a price that offers a clear margin of safety. Everything outside that zone, no matter how loudly the financial press announces its potential, is a corner pitch. He lets it pass. The professionals on Wall Street cannot afford to do this. They face quarterly reporting. They face client redemptions. They face peer comparison. They are structurally forced to swing at bad pitches because their business model demands constant visible activity. You have no such constraint. But here is the critical distinction the data forces you to confront. Patience alone is not the answer. A patient investor with no selection criteria is not disciplined. He is merely slow. Williams did not simply wait. He waited for a specific pitch in a specific zone based on specific, pre-mapped data about his own capabilities. The waiting was inseparable from the system. Remove the system, and the waiting means nothing. Patience without a framework is just slow failure with better intentions. So how exactly do you build the system? How do you define your own happy zone and know with confidence which businesses are worth swinging at? We have established what destroys wealth. Now we build what protects it. Patience is not a strategy. It is a prerequisite. But patience aimed at the wrong business is just slow failure with better manners. The open question is this: how do you know which pitch is worth swinging at? The answer begins with a single, honest question. Do you understand this business? Not the ticker symbol, not the chart, the actual business. How it makes money, why customers choose it over competitors, and whether that advantage will still exist in 15 years. Buffett calls this the circle of competence. It is not a fixed perimeter. It is a boundary you draw yourself around the industries and businesses you genuinely understand at a deep level. Everything inside that circle is your hunting ground. Everything outside it is noise. Most investors never draw this boundary. They chase whatever is moving. They own businesses they cannot explain in 2 sentences. And when those businesses fall, they have no framework to decide whether to hold, add, or sell. They panic because they never truly understood what they owned. Now, within your circle, you look for one thing above all others: an economic moat. A moat is what separates a good business from a great one.
It is the structural barrier that keeps competitors from eroding a company's profits over time. Without a moat, every profitable business eventually attracts competition until the advantage disappears. With a moat, the advantage compounds. Think about the brands you refuse to replace, the software your company built its entire operation around. These represent 2 of the 5 sources of a genuine moat: intangible assets like brands, patents, and licenses, and switching costs so deep that changing providers becomes more painful than staying. The power is not in the product alone. It is in the friction that surrounds it. 3 other sources complete the picture: network effects, where a product grows more valuable as more people use it, creating a cycle that new entrants simply cannot break into; cost advantage, where a company produces goods cheaper than any competitor, permanently, not situationally;
and efficient scale, where the market itself is too specialized to support a second profitable player. Together, these 5 form the architecture of durable business dominance. Morningstar's analytical framework classifies moats into 2 tiers. A wide moat signals a competitive advantage expected to persist for more than 20 years. A narrow moat signals approximately 10 years. No moat means the profits are temporary. Competition will eventually find its way in. Here is what separates a true moat from a mirage. High profit margins today do not constitute a moat. A technology lead without patents or switching costs is not a moat. It is a temporary advantage waiting to be disrupted. The moat must be structural, not situational. Rehook. Buffett once bought an entire company on a handshake with no formal audit for $60 million. Why would one of the most disciplined investors in history skip due diligence entirely? Because he understood the business.
Nebraska Furniture Mart run by Rose Blumpkin, known as Mrs. B, had a moat Buffett could see without a spreadsheet. She had built the largest furniture store in North America through an unbreakable cost advantage and a reputation for honest dealing that no competitor could manufacture overnight. The moat was self-evident. The handshake was the shortcut that competence earns. This is the circle of competence made concrete. Buffett did not need an audit because he had done the intellectual work long before the transaction. He understood retail, he understood cost structures, and he understood what Mrs. B had built. The confidence was not recklessness, it was preparation mistaken for intuition. Now, consider the daily financial news cycle. Taleb observed that consuming it does not sharpen your decisions, it corrupts them. The information feels like nourishment. It functions like poison. It manufactures urgency where none exists and makes the irrelevant feel critical.
More data, consumed faster, does not produce better investors. It produces more reactive ones. Buffett's response to macroeconomic forecasts and political predictions is equally precise. He ignores them entirely. He calls them costly distractions. The value of a great business over 20 years is not determined by who wins an election or what interest rates do in the next quarter. Those variables are noise. The moat is signal. Knowing this is insufficient. Philosophy without procedure collapses under pressure. So before you buy anything, write it down. The yellow notepad rule is simple. Before executing any transaction, write down 3 objective reasons why this specific business will retain its competitive advantage over the next 10 to 15 years. Not why the stock will go up, why the business will remain dominant. If you cannot fill the page, you are not ready to buy. The second procedure is the mandatory 24-hour cooling-off period.
Behavioral finance researchers recommend a full day between the impulse to act and the act itself. This is not bureaucratic delay. It is the structural separation of emotion from execution. Most FOMO-driven impulses do not survive 24 hours of honest reflection. The third procedure is the pre-mortem regret note. Before you invest, write down what a catastrophic outcome would look like and why it might happen. Not to talk yourself out of good decisions, but to ensure you are making a decision, not reacting to a feeling. The investor who can articulate their own worst-case scenario has already performed half of their due diligence. What these 3 procedures require is the one resource the market constantly works to destroy: deliberate, unhurried thought. They cost nothing. They are available to every individual investor, right now. The only barrier is the willingness to slow down in a system designed to make you speed up.
This content is for educational purposes only and does not constitute financial advice. But the underlying principle is not opinion, it is observation. The market is not your adversary. It is a mechanism, and its mechanism is redistribution, a continuous transfer of capital from those who act on impulse to those who act on understanding. The stock market has always been a device for transferring money from the impatient to the patient. The only question that remains is the one only you can answer. Which side of that transfer do you choose to be on?